We'll start with the first question. So from a humanitarian perspective, as Gareth mentioned earlier, the situation in Ukraine is a tragedy with no clear end in sight. Over the past 3 weeks, the West's response to Russia has come in the form of strong economic and financial sanctions. Brian, could you please comment on the macro implications?
And I first want to start by reiterating the point about the humanitarian suffering. I mean, everything that we're going to say about impact on real estate markets is really truly secondary to that. So I thank you for recognizing that. So let's try and bring it back to the economic side. So in the direct economic linkages, you have the direct impact on economic growth. Okay, this is obviously devastating for the Ukrainian economy for obvious reasons, and the Russian economy because of the sanctions and the way that the world is successfully isolating Russia. The economic linkages to the rest of the world, and including Europe, are actually pretty limited in the aggregate. So even the CEE countries, which have the closest trading relationships, such as Poland, only send around between 1% and 3% of their exports to Russia. But it matters very, very much what those trade links are, because it's not a diversified range of goods, it's heavily concentrated, which brings us to the indirect economic linkages, which are what is most important. So we really are focused on 3 channels of impact: inflation, generalized risk-off sentiment in the markets, and accelerated changes in the European energy mix. So quickly taking each of these, inflation. Those trade flows, as I said, look small by the numbers, but they're oil, gas, metals, and wheat. These are key economies. When I think about inflation, there's good inflation, which is the inflation that comes when economies are growing and operating close to full capacity. And there's bad inflation, when higher prices aren't being caused by or occurring alongside strong growth. And so this is really representing an extra dose of bad inflation at an unwelcome time. I also mentioned risk-off sentiment, risk aversion. So this is really creating a tightening in financial conditions, even before central bank tightening. So it's effectively an incremental tightening for risk assets, and real estate is a risk asset. And then finally, there's the energy mix point. There's a bit of a debate as to whether the surge in energy prices will accelerate or hinder the sustainability drive. I know that in US politics, there's some argument that this will just cause politicians to say, let's just drill, and get those prices down. That's not my view. I think that the focus on energy security will actually be an accelerator for green energy and decarbonization, the things that we've already been talking about to solve the other big crisis of the day, which is, of course, the climate crisis.
Thank you, and that's, we'll actually come back to you, Brian, for the next question on inflation. So inflation was certainly one of the major concerns last year, but it's an even greater concern today. According to the report, it is the second most concerning business issue after cybersecurity and before interest rate movements. So Brian, how does this differ across North America, Europe, and Asia, and how is it likely to play out in your view?
Yeah, so to sort of tackle that question, you have to break down the sources of inflation and think about them as separate, and how they vary across the globe is really helpful in really parsing that. So I'd really break it down into 3 sort of sources of inflation: the idiosyncratic factors, basically the shocks, cyclical factors, so that's the good inflation that comes with a economy at full employment, and then structural factors, which is more about the long term and demographics. On the shocks side, we've had shocks before Ukraine, right? It was COVID related. It was related to reopening. The crowding of demand into goods and over services drove inflation in goods. And then the sudden return of demand to services, when their capacity of service industries had been brought down, is causing inflation in services. So the COVID restriction start-stop and the impact on global supply chains is the is the shock that was just starting to fade when the Ukraine crisis hit. And those factors are, of course, global and have had a pretty broad-based effect on the three global regions. The shock to energy prices from the Russia-Ukraine situation, it kind of acts as a tax on the economy. It's also global. I'd say the impact is more acute for Europe, even more acute for Europe because of the gas linkages. Many European countries are pretty dependent on natural gas from Russia. It's just the way the infrastructure is designed, the way the pipes flow. There's insufficient infrastructure in Europe to really be able to buy enough LNG on the global market. And so that global tax on economies from energy prices is worse from a European perspective. So on the cyclical side, sort of the good inflation, there are divergences globally as well, just really related to the strength of the economies, relatively speaking. So the US recovery by far was the most advanced, so that's the most inflationary, cyclical inflation, while the European economy relatively slower recovery and a bit more fragile, so less inflationary. And in so many things, I say that the UK is positioned somewhere between Europe and the US, which is obviously geographically accurate, but I think the way I describe this as well. And then, China was also slowing. So a bit of a different state in the cyclical side of inflation. And then finally, that structural long-term element. All else equal, Europe, continental Europe, especially in Japan, have a long-term deflationary profile. The demographic picture may have a boost in some countries from refugees, but I think it's far too early to be talking about any kind of silver lining. At this point, it is simply a humanitarian crisis. And so that weaker demographic profile long-term means that the inflationary pressures and pressure for monetary tightening in general is weaker in the Eurozone and Japan than in the other major developed markets. But in general, as real estate investors, our biggest concern here is, of course, the pass-through of inflation. How much of that are we going to realize in rents, which Lars referenced? And also, what does it mean for the cost of capital, the cost of debt? Central banks are really caught between the risks to growth and that threat of inflation. So we have a policy announcement coming this week from both the Fed and the Bank of England. They've signaled that they're going to go ahead with those rate increases. I don't think it would be a surprise if that was coupled with some kind of caveat in the messaging. And I think the ECB will be more cautious. So we have a little bit of a decoupling based on that composition of the inflation, those types of inflation that I talked about. It's not just mitigation, but adaptation to climate change. So the climate crisis isn't just that we're contributing to climate change and to warming, but also that our cities and our buildings are not safe from the effects of the climate change that's already going to happen, even if we achieve our objectives or beat our objectives in terms of decarbonization. And so we need to do a better job at directing capital to the most resilient places that are going to be the best positioned places and cities that for a world that inevitably will bear the mark long term of climate change.